It's not like cutting it makes it crash. It's that usually something bad is happening, generally a softening economy or some sort of like, liquidity crisis or something. And so they cut rates in response to that, but then also asset prices are not doing very well because they have lower expected earnings.
Lyn Alden begins by setting the stage for her analysis of the Federal Reserve's potential rate-cutting cycle. She notes that unless a dramatic event occurs, which is always a possibility given the fragility of the markets, she anticipates a relatively mild rate-cutting cycle. This expectation is grounded in the notion that modest rate cuts, whether in the next meeting or shortly thereafter, would likely have a limited impact on the broader economy. The reason behind this, Alden explains, is that many individuals and businesses have locked in low fixed-rate debt. Consequently, even if rates decrease slightly, it won't lead to a significant wave of refinancing or drastically alter financial conditions. For example, a mild reduction in mortgage rates is unlikely to trigger a major refinancing boom unless the cuts are substantial, around 100 basis points or more. This means that the psychological impact of such cuts might be overstated, and their actual effect on the economy could be minimal. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Yeah, so my expectation, unless something dramatic happens, which is, markets are levered and fragile enough that that's always possible, but assuming nothing dramatic happens, I would expect a kind of a mild rate cutting cycle. So fairly modest rate cuts, maybe next meeting, maybe the meeting after that. We'll see what happens with incoming economic data and CPI prints. And other than psychological, I don't think it's that big of a deal if we get those mild cuts. And the reason for that is kind of similar to why rate hikes had kind of weaker effects than many people expected on their way up, which is to say that a lot of people locked in really low fixed rate debt. And so if mortgage rates or short-term lending rates or business rates, whatever the case may be, if that goes down a little bit, it doesn't really change too much. The people still have their locked-in debt. They're not going to refinance that for the most part. You're not going to get a big mortgage refinancing boom from anything less than probably like 100 basis points of cutting. And so I just don't think it's that big of an impact. And I think in general, people keep overestimating the importance of the Fed and underestimating the importance of fiscal, basically deficits versus surplus, in this case, very large deficits. I continue to view that as a much bigger factor than around the margins things that the Fed does. Now, of course, if they were to come out tomorrow and cut rates to zero, that'd be a huge impact. But if they just start a gradual rate cutting cycle, I think it's somewhat overblown what the impact would be. It's not like cutting it makes it crash. It's that usually something bad is happening, generally a softening economy or some sort of like, liquidity crisis or something. And so they cut rates in response to that, but then also asset prices are not doing very well because they have lower expected earnings because of a potential recession or a softer economy. And so normally rate cuts are not very good for market prices. This one could be different in the sense that they're coming down from higher than normal levels, at least in modern times with the amount of debt we have. And so going from high to kind of normal is different than going from, say, normal to low because of a economic softness. Basically, if the economy just kind of is average here, then their mandate of balancing employment and inflation can point toward mild cuts without necessarily implying there's a recession. Or a severe recession. It doesn't mean I'm super bullish on the S&P 500 because it's already, the valuations are rather high. So even if earnings don't have a meaningful dip, and even if we don't have any sort of significant recession, I just think that the forward return prospects are somewhat lackluster.
Alden also touches on the broader implications of these policies, drawing parallels to the experiences of emerging markets. She suggests that the U.S. might face a prolonged period of economic challenges, similar to what countries like Argentina have experienced with persistent inflation and fiscal instability. The U.S., while not on the same level as an emerging market, could exhibit some of these characteristics due to its large deficits, political polarization, and financialization of tax receipts. One of the key risks she identifies is the potential for a significant overhaul of the fiscal system, which would be necessary to address these structural issues. However, even if politicians were to take action by raising taxes, cutting spending, and reducing the deficit, such measures could inadvertently harm tax receipts and slow the economy, making it difficult to achieve meaningful progress. This could lead to a situation where the economy stagnates and the deficit remains wide, despite efforts to address it.
So when we look at the Fed, first of all, by raising rates, it does two main things. One, it makes the currency more attractive for foreign holders, so it strengthens the currency, all else being equal. And two, it puts more pressure on borrowers, so they're less likely to borrow, which means less money creation from the private sector, and just more chance of economic softness and weakening. On the other hand, the fiscal deficits, generally larger deficits, are stimulating for the economy. And with the offset of being potentially inflationary for the economy, especially if down the road those deficits become monetized again. And so it's kind of like trying to drive a car while also, you're putting the gas and the brake at the same time, which is kind of how the fiscal and the Fed are kind of acting with each other. And then the Treasury has other tools. So in addition to just the deficit itself being stimulating and inflationary, they also can shorten the average duration of the debt that they issue. And what that does, basically a T-bill is very similar to cash, right? There's virtually no price risk, and you get the full faith and credit of the U.S. in nominal terms, whereas if you have a long duration treasury, you basically have a lot of volatility and risk in case that interest rates go up in the future, including kind of that long end. And so by introducing more T-bills, they basically are issuing lower risk type of debt. And they're also, in this case, able to pull money out of the reverse repos. So there's a lot of money market funds, and there haven't been enough T-bills to accommodate that demand. And so what the Fed doesn't want to happen is for all that excess demand to push T-bill yields below their interest rate target, because that would defeat the purpose of trying to be hawkish, which they're trying to do. So what they do instead is they open the reverse repo facility and say, you can put extra cash here at this rate. So it makes it so that they don't drive T-bill yields below the target rate. But over time, as more and more T-bills come out, those money market funds can go and buy T-bills again. And so by doing that, it kind of keeps the market liquid. There's not like cash being drawn out from bank reserves and things like that, because as it's being drawn out, the repo facility is kind of putting cash back in. But the downside is that the government is funding itself with shorter average duration because of that. And it's kind of, looks unusual. They kind of have a target of how much of their debt should be T-bills, and they're currently over that target. Now, the somewhat unintuitive thing is that their average debt duration hasn't really gone down too much, because they also have issued a lot on the very long end in recent years, and so their average debt duration is not particularly out of normal. Just specifically their rate of very short-term debt is higher than normal. But if we look at how this normally plays out in emerging markets, it can just go on for a very long time. Like, look at Argentina. How long have they had serious inflation? Right? It's just year after year after year. Yep, it's still a problem. Yep, politicians still don't know what to do about it. Yep, it's still a problem. And I think basically what we're going to see in the U.S. is kind of a low-grade version of that. Basically a developed market with emerging market characteristics around the margins, which is to say structurally big deficit, no appetite among politicians to be able to fix it, high levels of polarization to even figure out how they would fix it. And then what makes it even harder is that should they somehow fix it, let's say somehow next week both parties get together and say, okay, we're going to raise this tax, we're going to cut this spending, and we're going to do this, we're going to get the deficit down to 2% of GDP instead of 6% of GDP. If they were to do that, the problem is that the US tax receipts are more financialized than most other countries, meaning that if stock prices go down in Europe, it doesn't affect European government finances as much, whereas if stock prices go down or even just sideways for a while in the US, our tax receipts start to suffer. It's a couple reasons. One, we have more wealth concentration, and two, a lot of our CEO and executive compensation is very much tied to the equity and options and things like that, basically the performance. And so you can have a situation where you could try to do austerity, but then ironically hurt your tax receipts and potentially keep the deficit as wide or similarly wide while also having a slower economy. So nothing short of a very significant overhaul would basically stop the train, and probably after a pretty material currency devaluation as well. The way I would kind of phrase it is that things can break, but sometimes that thing that breaks is not very dramatic. Because it's kind of like a plumbing issue that gets fixed right away. Probably the best example is the repo rate spike of September 2019, right? That was one of those things that everybody who's like focused on macro freaked out, and technically, if left unaddressed, that would be a catastrophic problem. But it wasn't like banks were going down. It wasn't like we were having some big noticeable thing for anybody outside of finance. It was this little like micro break that was fixed, within a 24-hour period, thanks to money printer go burr, and we just kind of mildly then, things started to do well. Asset prices went up until, of course, we ran into COVID, and so I kind of see a similar thing like that, where we get some mild breakage somewhere, and then that's the Fed's signal to kind of go back to balance sheet expansion. And the funny thing is, the New York Fed is basically expecting that. Right. So in their annual report, they look out and they kind of look at, say, by the end of 2025, they probably expect to go back to balance sheet increases. And so they would not phrase that as QE, because in their model, and of course things could change based on if we get a recession or something, maybe, but in their model, basically recession aside, they would go, this quantitative tightening, we eventually would run out of the reverse repo facility, and any sort of further tightening would eat into bank reserves. And they want to maintain what they call an ample bank reserve environment. And so once you get down to a certain level, you get something akin to like that repo spike, or you could technically try to stop right before something like that happens, or just use something like that as a signal. And then when they do go back to balance sheet growth, it doesn't necessarily mean like what we saw in March 2020. It doesn't mean, balance sheet goes straight up, but their target is to grow the balance sheet in such a way that it's a constant percent of GDP.
In conclusion, Lyn Alden provides a comprehensive analysis of the current economic landscape, emphasizing the complex interplay between monetary policy, fiscal deficits, and market dynamics. While the Federal Reserve's actions are important, it's the broader fiscal environment that truly shapes the economic outlook. As investors, it's crucial to keep these factors in mind when making decisions in an uncertain and ever-changing market. Thanks for watching. If you enjoyed this video, don't forget to like, share, and subscribe for more insights on investment strategies and financial tips. Leave your questions and comments below. I'd love to hear from you. See you in the next video.